Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Fund Development Analyst. We are pleased to welcome today Marc-Olivier McNulty, Vice President at Hexavest, here to talk to us about their strategy and perspectives in an environment where the volatility in financial markets came back in force. Please note that if there is enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A section of the WebEx interface. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Marc-Olivier, the floor is yours.
Thank you, Mathieu, and thank you all for joining us today. So what we'll be going through over the next 30 minutes is really talking a little bit about Hexavest, who we are as a firm, and also what our process is all about when we invest in global equities. And would like also to spend maybe at the end of the presentation a couple minutes to speak about our views on the world, given all the volatility that we've seen in the first part of the year. So really over 30 minutes, you should get a good insight in terms of who we are and what we're looking for. So we'll go on right away into page 3 of the deck to talk about a little bit of our firm. So here you can see that we're Montreal-based. We've been always here in one single office, and we manage equities for institutional investors around the globe. Although the firm was launched 14 years ago, it's important to note that the investment team has been managing international and U.S. equities since 1991, so now going on to 27 years of track record. 47 employees, 20 billion in assets, and our approach is really unique in terms of being top-down. We are certainly value biased, and we do use a contrarian style in a certain part of our process, which we'll get down to a little later. Hexavest is known to be very good in downside protection and also in market reversals. That's really been the bread and butter of what we do. As being top-down, we look at various sources of added value. We start off at the regional level, going down to countries, and then sectors, industries, and finally we build out our portfolio. So really 80% of our time is spent on analyzing data on country, sectors, and industry, 20% on stocks, and that's really what we're about. When you look at client types, mandates, and location, you can see that our business is really institutional. It's focused in global equities. 85% of our business is driven through all country and global. And finally, our client base is really worldwide, where 40% is in Canada, and the bulk of it is, the balance of it is in Europe, Asia Pacific, and in the United States. So maybe moving on to our investment team on page 4, give you an idea in terms of who manages the equity portfolio. Inside the brackets, you see a group of 12 individuals, most of them portfolio managers. So you can see that there's a great depth of experience, over 200 years within these 12 individuals. Should be noted that we were going to be growing the team to 14 over the next few months. And the way that it's broken down is you have 4 regions that manage the portfolio: emerging markets, North America, Asia Pacific, and Europe. Each portfolio manager within its region builds out its portfolio. But you can see in the highlighted box, there are 2 individuals that are comprised of Vital Prou, the founder of the firm, our CIO, and Jean-Pierre Couture, our chief economist. These 2 individuals have the responsibility of building out what we call the global outlook, and the global outlook will allow each portfolio manager to invest in companies that really reflect the global outlook. So as you can see, it's a great number of people managing really the bulk of our assets, and that's really been how we've been managing since 2004. Moving on to page 5, to give you an idea in terms of the investment process. So when I talk about the global outlook from the strategy team, basically they take the decisions on the 4 highlighted box here, as you can see. First of all, we start off at the risk level. So what does risk level mean? Risk level really entails what we foresee for the next 12 to 18 months in terms of equity markets. So we'll question ourselves first, do we see the markets going up or going down over the next 12 to 18 months? If we see them going down, we will assess a higher cash allocation, and we will most likely also have a lower beta on our portfolio. The second box is really on thematics. So thematics, what does that mean? It could be anything from really having a theme on large cap versus small cap. It could be a theme related to energy. We know the energy sector is global in nature, so it doesn't mean that we would necessarily do that at the regional level. We would do it certainly at the strategy level. If we like gold stocks, that's where it would be implemented. Third box, regional allocation. Well, that's quite simple. If the strategy team believes that Europe's going to outperform the United States over the next 12 to 18 months, therefore we'll allocate more money to the European equity team, and then they'll go through their own process. Finally, the last box, currencies, which is something that truly differentiates Hexavest from its competitors. We actively manage currencies, so we do take positions, and that's quite normal in a top-down shop, where we look at a slew of information really at a macro level, so currency bodes well. Currencies have actually been generating approximately 25% of the added value in the global equity strategy since inception back in 1999. You see then the regional teams. So the regional teams have a responsibility of managing their own region, always taking into account the global scenario that's been highlighted through the strategy team. So they'll implement the countries they like, the sectors, and finally the industries in which they want to invest in. That's the top-down part of the process. Obviously, we have to build it out into a portfolio of stocks. So what we will do is at the portfolio level, you will see that typically we'll hold between 250 to 300 stocks in the portfolio. It seems like a lot, but it is by design. It's the way to ensure that we can correctly implement our top-down views at the country, sector, and industry level. We are not known to take stock-specific risk. The last thing we want to do is make a call on a sector and be right about it, but take the wrong name in that sector for various reasons. So that's why in a specific sector, if we like that sector for the next year or so, we will implement it through probably a number of names that is higher than usual. So we also use ETFs and futures in our strategies. We use that mostly on a tactical basis. So if we see a market dislocation in the markets, we will rapidly implement a strategy. For example, if emerging markets were to correct by 5 to 10% in a few days, the fastest way to implement the strategy there would be to buy futures or to buy ETFs in the emerging markets and then unwind that position over the next following days so we can capture that dislocation. Page 6 is really on every investment decision. We go through the same process of analyzing the 3 pillars that you see here. So first one is the macroeconomic environment. What are we looking at when we look at macro data? We're looking at a slew of information that really relates on a country level and at a sector level. So it could be anything from looking at economic growth forecasted by analysts over the next 12 months. We'll look at unemployment rates. We'll look at inflation. We'll look at interest rates at a country level and see which ones we like and dislike. You see some positive signs and some negative signs there. For each of the vector, we will assess all the way from a triple negative if we really dislike what we're seeing, all the way to triple positive if we're very bullish on that specific decision. So that's for the macroeconomic environment. As for valuation, we do the same assessment, but now we'll be looking at typical valuation metrics that everybody knows, whether it's price to book, price to sales, earnings yield, dividend growth, ROE, things like that. And we will basically ask ourselves, given the macroeconomic environment that we see, how much are we paying for that outlook as we speak? So if we believe that the macro is okay, but that valuation is very high, that will be negative in our scenario. Finally, sentiment is the third and final pillar. sentiment is the pillar in which we assess our contrarian view. So if everybody is positive on a sector or an industry and has been for a very long time, that would become a negative for us. So what we do when we assess sentiment, we look at many, many data points. We'll look at fund flows from institutional investors. We'll look at their holdings. We'll look at relative performance from one region or one country versus another. We will look at how strong the momentum is in the short term and in the long term. And once we have compiled all of this data, we take a view on sentiment and apply it. So at the end of the day, when we've applied all these three vectors for every decision, we add up the pluses and minuses. And if we, at the end, get to more pluses, we should have an active overweight in that decision versus its benchmark, and vice versa. If we're bearish on that, we will be underweight or completely out of that specific trade. So that's really the highlights of our vectors analysis. If we go on to the next page on the risk monitoring. So risk monitoring for us is extremely important. And how do we do that? We have installed many deviation maximums and minimums at a regional, country, and currency level, basically being at 15% plus or minus versus its benchmark. At a sector level, we do not want to deviate more than 10%, and we do have a cash allocation up to 10%. Cash for us is almost a 12th sector in which we can invest in, and we use cash to protect capital, especially in volatile episodes and down markets. That cash can not only preserve capital, but seize great opportunities as markets fall. Finally, non-benchmark countries in an ACWI portfolio, certainly this bodes well to frontier markets. We don't necessarily need to go there, but as certain countries become more and more developed, they could become interesting in this strategy. In terms of portfolio characteristics, you can see we hold anywhere from 375 to 475 names. The sole difference with global equities, which is really based only on developed markets, the ACWI portfolio combines both developed and emerging. That is why we have a few more names in this portfolio. And at the end of the day, we are very active. We try to seize market dislocations, so portfolio turnover can vary anywhere from 35 to 100%. On average, we've been between 50 and 60%. So through our process over the last 20 plus years, here's what you can expect on page 8 in terms of risk profile with Hexavest. So here we've put the global equity strategy. Why? Because obviously it has a longer track record than our ACWI strategy, but it's to give you a sense in terms of how we perform in various market environments. So the first table on the upper left is really the volatility versus the added value that we've generated over time. So these are 5-year rolling periods. And typically, you always want to be in the upper left quadrant of that chart. Why? Because that means you are adding value versus your benchmark, but taking less risk. And we've been able to do that on a pretty stable and systematic basis. And when you look at the bottom right chart, it's really, I guess, the DNA of Hexavest. You see here that in down markets, there's been 69 periods of 12-month rolling down periods since inception in '99. And out of those 69 periods, we've been able to outperform 99% of the time. And the important part is not only the success rate, but also the average added value through that period. So 7.7% in a downturn is quite significant. It actually brings Hexavest in the top decile of downside protection globally of all global equity managers. And up markets, we do capture most of the upside, 52% of it. Last year was a year that erased a little bit of that up market capture, but certainly we've been able to benefit on both sides of the trade. So all in all, since inception, we've added 2.7% of value to our clients. The next page on page 9 is the same table, except that now it's for the all-country equity, so the ACWI portfolio. It has obviously much less much less length in duration. But what you can see on the bottom right chart is that basically we've had a 100% success rate in down markets since 2010, adding 4.6% of value. In up markets, it's been a little tougher, but we got to remember that the equity portfolio did not go through the financial crisis, did not go through the tech bubble, and those are areas in which we did extremely well. So you can expect that there could be a mean reversion there, and that this portfolio will also do well in an eventual market correction. So if I move on to the next page, on page 10, it's just a quick word on ESG. We've been a signatory of the PRI since 2012, and people are more and more conscientious about ESG issues. This issue is really followed by the institutional world. And inevitably, in our opinion, this will be an important factor for retail investors in years to come. So all we're saying is that we want to be at the forefront in leading this space over the next few years. And as such, many efforts are dedicated to ESG within our investment activities. One thing that we do is, every portfolio manager has to assess at least 5% in ESG scoring in its portfolio. And we also take strong pride in proxy voting and engaging with the companies in which we invest. So that's really the process of Hexavest. Now let me go to the next section and really talk to you about what we foresee over the next 12 to 18 months. So I'll bring you to page 12, and here is when I talk about our global market outlook. This is done on a quarterly basis, and this is our most recent market outlook. So we break it down in two boxes. One at the global level, so for global equities and equities, you have the three vectors that we are currently assessing. So the macroeconomic environment, valuation, and sentiment. And at the bottom, you see on a regional basis, this is really in relative. We still have to invest at least 90% of the capital for investors in equities, so we have to favor certain regions versus others. So if we start at the top, global outlook, the macroeconomic is neutral. For us, certainly 2017 was a great year. Economic growth surprised globally on the upside and really above potential. But we think in 2018, we're going to come back to more normal levels and probably be closer to the global economic growth potential. We believe that economic growth will probably come below what forecasters are looking for in 2018. We feel that the U.S. economy is the first one to probably slow down after a 9-year cycle, so it's getting pretty long in the tooth. And where we are much more positive is really in Europe and to some extent in Asia Pacific. Emerging markets, you can see we have a negative. It's still growing at a faster clip than developed markets. But why we have a negative there is really we believe China is really on a slowdown path, and therefore that is a significant portion of emerging markets. As for valuation, we are triple negative, so the most negative we can be. Why are we so negative? Mainly because of U.S. equities. We find that the U.S. market is extremely expensive. It's pricing out a Goldilocks scenario for the next 12 months, and a lot of people have been extrapolating the great results we saw in 2017 to 2018. We can remember that last year, earnings growth for U.S. companies was at 21%, and now we're forecasting another 12% of growth in 2018, which in our opinion is quite a task and probably a little difficult to attain. So valuation in the U.S. expensive. Asia Pacific, you'll see in later charts that is cheaper. Europe as well, but there's no bargain in this current market. Everything is expensive. If you had to choose, certainly Europe, Asia Pacific is probably the place to be on a valuation basis. So sentiment, as I said, this is where we assess our contrarian views. Triple negative there again. We feel that there's been a lot of risk taking by investors over the last few years. We've seen very calm markets with very little volatility, and that's given investors the sense of invincibility, basically taking on more risk and being rewarded for it. So if we do see volatility come back, certainly we feel that people could be shaken a little bit and take more defensive positions. Many portfolio managers continue to manage risk through asset volatility. This, in our opinion, is very hazardous. And if risk has to be reduced, we can see a quick change in asset allocation, and that's why we have a triple negative. So going on to page 13 to assess really the opportunities that we see in the market versus the risks. So really the Eurozone is our favorite region at this point. Better growth, it's cheaper, and it's been shunned by investors. So therefore, really this is where we'll invest heavily over the course of the year. Inflation and interest rates, a lot of people feel that interest rates are going higher. We are of the opinion that they've gone high enough at this point, and that if they were to go any higher, it would probably have a significant impact on the real economy, as several companies are highly leveraged. Actually, we haven't seen this high leverage in corporations since the great financial crisis. Finally, opportunity in value versus growth. We've seen a significant underperformance of value over the last 40-plus years, and we haven't seen this in quite a while. So we feel that value is much more attractive at this point than growth and or momentum. On the risk side, the number one risk that we foresee in the markets is really what I talked about, is seeing the return of volatility. People feel that the more risks you take, the more you are rewarded. We can just think about what people have been chasing in the last few months, whether it's pot stocks, whether it's cryptocurrencies, whether it's artificial intelligence. People are really looking for the next thing. So that gives you a good sense that people are looking for ideas. Whether or not there's risk, they're piling into these trades. Fiscal slippage in the U.S., really, we are concerned by the rapid growing deficit in the U.S. Obviously, we've seen tax cuts in the U.S. That certainly helps in the short term, but long term, you're kicking the can down the road. So certainly, a growing deficit could have an impact on interest rates in the U.S. to the upside, which would be a risk to our base scenario. Finally, trade wars. We've talked a lot about it in recent weeks, namely China versus U.S. We feel that's probably low probability. It is certainly ignored by investors. The administration of Trump is pushing this not on an economic basis. They know very well that having a trade war is very negative to everybody, but certainly from an electoral perspective, it is quite positive. We know there are midterms coming in November in the U.S., and we feel that is why they're pressing the trade war button as we speak. So moving on to page 14, we look at just one chart for every vector to really highlight our views. So here we have consensus on the regional forecasted growth for the 2018 year. So again, we're not too concerned. 3.2% estimated growth. We feel that it'll probably come in a little lower than that, given that the U.S. will slow down. And where we see obviously better potential is in Europe. Emerging markets is still growing at a fair clip, but it is certainly not at the stage that it was perhaps a decade ago. So on that, really, we remain neutral. Really, it's really dependent on the U.S. economy. Moving on to next page 15. So on valuation, why do we feel markets are extremely important? While we saw a recent sell-off, we saw valuations contract somewhat since December, but not in a meaningful way. You know, we look at a broad set of valuation metrics that you can see on the table on the left, and you can see that the world remains very expensive, with an average decile, the world going from 9th decile to 8th decile. Certainly 8th decile is better than 9th, but it's still expensive on a historical average. When you break it down by region on the right, clearly the U.S. stands out as being the most expensive. It's in the 9th decile of its historical range. Europe remains somewhat expensive, but has seen valuations come down, and therefore that's why we are a little more positive on Europe. The cheapest region is clearly Japan, which also carries out a double positive. It should be noted that Japanese equities did live in an equity bubble in the 80s, so it does skew the data somewhat. But nonetheless, that market has seen a contraction in valuation over the last 15 months, and in our opinion, the most attractive valuation level in global markets. So the next page is our internal valuation index, which compiles a bunch of valuation metrics. In this chart, you see that our expensive index is in red, and the blue line is what is typically forecasted for the next 12 months in terms of returns in global equities. So the red line, the higher it goes up, the inverted axis in blue shows that you should see negative returns in equity markets for the following 12 months. We've come back to a double negative, so somewhat a little bit of a pullback in valuation, but still remains expensive. In our opinion, we should foresee over the next 12 months a pullback in equity markets of about 10%, probably a little more in the U.S. and a little less in other regions. Finally, on sentiment, page 17, you see here the difference in style performance. So clearly, value has underperformed significantly since the beginning of 2017. Momentum stocks have really shined. And you see that little orange box on the momentum line, which is in blue, basically showing the volatility episode we saw late January, early February. Momentum stocks have performed in the rallies. It also outperformed in the market correction and is still outperforming today. We clearly think that this is about to end. We really feel that the best opportunities remain in value stocks. A quick chart on also on where people see interest rates going. You can see on the left, this is all the speculators that are shorting U.S. government bonds. That means that people are really positioned for a rise in interest rates. The last time that this occurred was really at the beginning of 2017, which also marked the high for the year in interest rates. Subsequently, the 10-year treasuries in the U.S. declined by 60 basis points between March and September. So in equities, when you look on the right, the consensus is really showing that people have a large underweight to high-yielding sectors like telco and utilities, which are really negatively correlated to interest rates. And as contrarian investors, we will tend to buy the utilities, the staples, the telecoms, rather than technology, insurance, discretionary, which is very cyclical in nature, and usually are the ones that correct the most if we anticipate a market downturn. So all that said, how are we positioned in the all-country portfolio on the next page? You can see here really the main characteristics of our portfolio. I'll start on the top right. So in terms of sector deviations, this is where most of the active risk in the portfolio is. It's not so much at the country level. So you can see that we're shying away from really the more cyclical sectors like industrials, information technology, consumer discretionary, and financials. What we like most is really companies and sectors that have high visibility on earnings. And if we do see a market correction, telecoms usually do well. People continue to use data, pay their cell phones. Utilities, we still continue to use electricity. Healthcare, we need medication. And staples, we basically need to feed ourselves. So we feel that that's probably the more stable sectors you want to be in the near term. In terms of currency, that's changed somewhat over the last few days. This was in date of March 31st. We continue to like the Japanese yen because it does act as a safe haven in times of market downturns. The USD also, we do have a small exposure to the US dollar, but we are underweight the commodity-driven currencies such as the Canadian dollar, Australian dollar, and also given our view on China, we are underweight the Chinese yuan. In terms of geographic deviations, you can see that really what stands out is North America, so that's really the U.S. We're maximum underweight in the U.S. at nearly 14%. We are now overweight 5% in Europe because we've reduced our emerging markets exposure somewhat. The reason being that emerging markets have performed so well over the last 2 years that we feel now that if there is a market correction, emerging markets will underperform Europe, and that's why we've decided to reallocate to Europe. The cash level remains at 9%. Remember that our maximum cash level is 10. We feel that it is warranted to have cash at this point. So in the context of expensive markets and strong risk appetite, we feel it's justified to have a prudent, stable portfolio. the February sell-off did shake the confidence of investors, and we believe that the repositioning towards defensive sectors will occur. And to that front, we want to become more a capital preservation strategy more than outperforming in a very high beta type of market. So on that concludes the presentation. Perhaps we can open it up to questions.
Absolutely. Thank you, Marc-Olivier. So first question, what is the amplitude of a potential drop in financial markets, and what would trigger such a drop?
So we believe, 10 to 15% from current levels would be certainly justified. So markets going down 10, 15% should not be something abnormal. We haven't seen it in several years. And we think that the trigger will most likely be the return of volatility. There's been so many various strategies that have been created over the last few years. You just have to think of low volatility strategies or systematic strategies. These strategies have piled into very risky assets where we feel that people have really mistaken risk and volatility. Volatility is really a discrepancy of returns over time. Risk is totally different. So you look at low volatility strategies today, they own more than 15% in technology companies. Technology in nature is supposed to be a volatile sector, but it doesn't seem like it is at this point. So we feel that really a spike in volatility will be the trigger to the market sell-off.
Okay, and could you comment on the reason for keeping such a high cash balance?
Yeah, so cash balance goes hand in hand with the market correction. But the other point I want to make is that everything is much more expensive than historically. What I mean by that is although defensive sectors are a little cheaper than cyclical sectors, they are still expensive on an absolute basis. So if you would see a market correction, we could see cyclical sectors do much worse than defensives, but defensives could go down. When you do have cash, at least it protects 100% of that downside. So we want to have the cash not only to protect, but also to redeploy in probably some of these more cyclical sectors that we think are going to undershoot in times of a market correction.
All right. Well, thank you very much, Marc-Olivier. Very interesting presentation. To all of you who have listened to the webinar, thank you for your participation, and come back in May for our next webinar with AlphaFix. So thank you. Have a good day.